Welcome to all the participants. I hope you got a chance to go through our financial results and presentation that is uploaded on the stock exchange as well as on our company website. At the outset, I want to inform you all about the recent change in the management team at Navin Fluorine. Mr. Sitendra Nath Chaudhary, the current Chief Financial Officer of the company, has tendered his resignation in order to pursue his career interests beyond the company. This resignation has been accepted by the Board of Directors at its meeting. His last day of working with Navin will be 15th June 2018. Also, based on the recommendations of the Nomination and Remuneration Committee and the Audit Committee, the Board of Directors has decided to appoint Mr. Qtr4, who is currently Vice President Finance, as the new Chief Financial Officer of the company. The change will be effective from 16th June 2018. I would like to introduce to you our new CFO, Mr. Qtr4. He is a chartered accountant and a cost accountant by profession. He has been associated with the company for past 21 years and has worked across various facets of finance, accounting, MIS, system design and integration, business planning and analysis and acquisition in his tenure with the company. I have both Qtr and Sitendra with me on this call. First, I'll give you a brief business update followed by commentary on the financial results by Mr. Sitendra Nath Chaudhary. In FY18, the company reported excellent set of numbers. And to reward its shareholders for their great support, the Board of Directors not only recommended a final dividend of Rs 3.60 per share of the face value of Rs 2, that is 180%, but also announced a special dividend of Rs 3 per share on the shares of face value of Rs 2 each, that is 150% for FY18. This special dividend is on completion of 50 years of business operations. We are very glad that our business performance has maintained the momentum for yet another year. We believe our focus on our fluorination chemistry expertise holds the key for our great success and have started yielding consistent results. We are committed to total customer satisfaction by identifying their specific needs, translating them into quality products, and be a dependent long-term supplier for them. All our efforts and dedication are towards moving up the value chain in the fluorination chemistry. We believe the fluorination chemistry offers huge growth opportunities, and we are confident of capitalizing these opportunities with the help of strong R&D capabilities and recent CapEx announced. Each business unit is contributing to the overall growth in profitability and thus improving the return ratios. The recently announced CapEx plan of Rs 115 crore at our Devas facility, investing in third CGMP facility, is progressing as per schedule. Our net revenue from operations for FY18 is Rs 873 crores, which is a growth of 26% over the corresponding period of last year. The EBITDA for FY18 grew 41% to Rs 211 crores over the same period last year. Now let me begin with giving you BU-wise update. CRAMS. The BU revenue of Rs 258 crore for FY18 includes Rs 56 crores from Dahej operations. Non-Dahej revenue for CRAMS business has grown by 66% compared to last year. The business is doing well and is in line with our expectations and business plan. The utilization had increased, and once we reach optimum level, we will be ready with our new facility to support our next cycle of growth. However, I would like to reiterate that which I have been saying all along, that we should not overlook possibility of quarter-to-quarter fluctuation in this business due to very nature of this business. Coming to Specialty Chemicals BU, as all of you are aware that last few years this segment has been facing significant headwinds. The ongoing challenges in this BU have required our focused attention to reshape our strategy in this BU. Our Specialty Chemical revenue for the financial year 2018 has remained flat at around Rs 226 crores compared to last year. We are yet to see green shoots, especially in the global agrochemical business. However, some traction has been witnessed for our existing products in the export markets, which should help us going ahead. We continue to work on the R&D and developing newer molecules as per our plan. Refrigerant BU. The BU has improved the performance by 14% with a revenue of Rs 242 crores in FY18 as compared to Rs 211 crores in FY17. Export business has contributed significantly and performance is attributed towards better price realizations. We expect the growth momentum to continue in the coming quarter. Coming to inorganic business, This BU performed well for this year by growing 23% in FY18 compared to the last year. Our focus is on export market, where we are seeing good demand coming from the exports. Our efforts are giving us good results in this segment. The current situation in China has also helped us in identifying new international customers. Our volume and price extraction in this segment of our business has been improving due to sharper focus on global cues on supply-demand situation. Now I hand over to Sitendu, who will take you through the financial performance of the company.
Thank you, Shekhar, and a very good morning to all the participants. I will share highlights of our financial performance, following which we will be happy to respond to your queries. Please note that the financials of the company are prepared in accordance with the company's Indian Accounting Standards Rules 2015, prescribed under Section 133 of the Companies Act 2013, which is better known as Ind AS. First, I will discuss the financial performance for the fourth quarter and then the full year ended March 31st, 2018. The fourth quarter. For the fourth quarter, the company registered a net revenue from operations of Rs 208 crores, a year-on-year growth of 5% from Rs 198 crores in the same period last year. Refrigerant gases BU saw a growth of 17% from 57 crores in fourth quarter of FY17 to Rs 66 crores in Q4 FY18 and contributed 32% to the net revenue from operations in Q4 FY18. This business unit has recorded exports of approximately 38% during the quarter. CRAMS revenue, excluding the Dahej operations, has registered a growth of 32% to Rs 39 crores in Q4 FY18, up from Rs 29 crores in Q4 FY17. Share of CRAMS revenue in the enterprise net revenue from operations has increased from 16% in Q4 FY17 to 19% in FY18. In Q4 FY17, CRAMS had revenue from the Dahej operations, which stood at 15.78 crores. As you were aware, the business transfer arrangement has been executed and the Dahej operations have been transferred to the joint venture Convergence Chemicals Private Limited with effect from 1st of December 2017. Revenue from inorganic fluorides business unit is Rs 43 crores for the fourth quarter FY18, which grew by 29% year-on-year from Rs 33 crores in fourth quarter FY17. This BU contributes 21% to the total revenue of the company, and share of exports has increased from 11% in Q4 FY17 to 13% in Q4 FY18. Performance of the specialty chemicals business continues to be subdued compared to other business units due to the factors enumerated by Shekhar in his speech. Specialty Chemicals BU recorded a revenue of Rs 61 crores in the fourth quarter FY18, down 3% from the same quarter last year. As percentage to total revenue, the BU has contributed 29% in the Q4 FY18 as compared to 34% in Q4 FY17. 38% of this BU's revenue has come from exports. Operating EBITDA, which excludes other income for the quarter, registered a growth of 22%, up from Rs 37 crores in Q4 FY17 to Rs 46 crores in Q4 FY18. Operating EBITDA margin has improved by approximately 305 basis points to 22.1%. Operating profit before tax, which excludes other income for the quarter, was at Rs 38 crores compared to Rs 27 crores in Q4 FY17, which is a growth of 41% year-on-year. Operating PBT margin for the quarter grew by approximately 461 basis points to 18.2%, up from 13.6% in Q4 FY17. Profit after tax was Rs 39 crores in Q4 FY18 registering a growth of 7% on a year-on-year basis from rupees 36 crores in Q4 FY17. Moving on to the annual performance, the company has registered a net revenue from operations of rupees 873 crores, a year-on-year growth of 26% from rupees 695 crores in the same period, which is the whole of last fiscal, on standalone basis. On consolidated basis, the top line of the company stands at rupees 912 crores, a year-on-year growth of 23% from rupees 741 crores during the last financial year. Key drivers for this growth have been the continuing growth journey in CRAMS, improved realization in the refrigeration gases business, and positive traction in demand by end-user industries in inorganic fluorides business. Refrigerant gases business saw a growth of 14% from rupees 211 crores in FY17 to rupees 242 crores in FY18 and contributed 30% to the net revenue from operations for the company as a whole in FY18. The business unit has recorded exports of approximately 35% during the fiscal. CRAMS revenue, excluding the hedge operations, has registered a growth of 66% from rupees 122 crores in FY17 to rupees 202 crores in FY18. Share of CRAMS revenue in the enterprise net revenue from operations has increased from 18% in FY17 to 25% in FY18. Total CRAMS revenue has registered a growth of 87%, which stood at rupees 257 crores for FY18 compared to rupees 138 crores last year. This includes revenue from the hedge operations of rupees 15.78 crores during the FY17 and rupees 55.68 crores during the current fiscal till 30th November 2017. Revenue from inorganic fluorides business unit is rupees 148 crores during the fiscal, which grew by 23% year-on-year from rupees 120 crores in FY17. This BU contributes 18% to the total revenue of the company, and exports have increased from 8% to 13% in FY18. Specialty Chemicals BU recorded a revenue of rupees 226 crores in FY18, which is similar to that of the last year. As percentage to total revenue, the BU has contributed 28% in FY18 and as compared to 33% in FY17. 38% of the BU's revenue comes from exports. Operating EBITDA, which excludes other income for FY18, is at rupees 211 crores, registering a growth of 41% year-on-year basis from rupees 150 crores last fiscal. The operating EBITDA margin expanded by approximately 255 basis points to 24.1% on standalone basis. On consolidated basis, operating EBITDA, which excludes other income for FY18, is at rupees 215 crores, registering a growth of 35% on year-on-year basis from rupees 159 crores last fiscal. The operating EBITDA margin expanded by approximately 212 basis points up to 23.6% in the current fiscal. Operating PBT, which excludes other income, grew by 42% to rupees 172 crores in FY18, up from rupees 121 crores during the last fiscal. Operating PBT margin improved by 226 bips from 17.4% in FY17 to 19.7% in FY18 on standalone basis. On consolidated basis, operating PBT, which excludes other income, grew by 38% to rupees 174 crores in FY18, up from rupees 126 crores in FY17. Operating PBT margin improved by 201 basis points, up from 17% in FY17 to 19.1% in FY18. Profit after tax is at rupees 179 crores for FY18 compared to rupees 132 crores in FY17, a growth of 35% year-on-year on standalone basis. PAT margin stood at 20.5%, which is an improvement of 141 basis points compared to the last year. On consolidated basis, PAT stood at rupees 183 crores, a year-on-year growth of 33%, with a margin expansion by 152 basis points to 20%. For the fiscal, return on net worth stood at 18% compared to 16% in FY17, and return on capital employed during the fiscal is 27% as compared to 22% in FY17 on standalone basis. That is all from our side, and now we can open the floor for Q&A. Thank you.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Sangeeta Purushottam from Qtr4 Advisors. Please go ahead.
Yeah, hi. Good morning and congratulations for a great performance last year. I had 2 sets of questions. Firstly, would it be fair to say that in terms of the business on the specialty chemical side, the challenges that you experienced last year are likely to continue this year also? That was one. Secondly, on the CRAM side, given that we are in the process of establishing a new facility, what is the headroom we have in terms of our existing capacity to grow? That was on the business side. As far as the numbers are concerned, I just wanted to understand that in the other income, if you could give a breakup between what is going to be the recurring other income and the element which comes because of mark-to-market of the investments which are being held. What is the cash on the books right now? And what is the market value and book value of the investments that we are still holding?
Thanks. You had too many questions. I'll start answering and then probably you'll have to repeat a couple of questions again. Regarding CRAMS business, yes, we have capacities. The way we have planned this business and the expansion is based on our understanding and our visibility in terms of the business, what would come in. So from the CRAMS perspective, we have optimum capacity available for this year's sales expectations. And the new capacity, as we have said, it will come online by end of first quarter, early June 2019. So we are going as per our expectation for this business. So we are on track in terms of the CRAMS business activities. I forgot the first question. Was that regarding specialty chemical business?
Yes.
Yeah. So specialty chemical business, as said, the issue what we had, which were regarding the agrochemical intermediate business, which is more of exports to some of these large companies, that had a few challenges. We feel the challenges still continue in this business. We also had some challenges in terms of sale to some of the products in the local pharma business. What we have been doing in the last couple of quarters is we are trying to look at our product portfolio and try to see that we are not really into this kind of situation, and we are increasing our customer base. We have put some new products into the market which go into the pharma sector, and that's the way we are trying to reorganize our portfolio. Our R&D backup continues to churn out the newer products into this segment. So we feel that our dependence in terms of this particular segment would come down over a period of time. So we have taken certain very definitive steps to improve our outlook for this particular specialty business.
Okay. And so is there a sense you have that this business will grow in, say, the low single digits or something this year as these steps come into play, or will the growth actually happen in FY20?
Oh, this business has the potential, and we are confident to grow this business in a double digit. And I see no reason why we should not. These kind of things which are happening in this particular business for a certain situation which has come up. But overall, if you see our product line, our customer base, our geographic reach, all those things are good enough to take the advantage of the market as soon as it changes.
Okay. And in terms of CRAMS, given whatever facilities we have, what is the optimum revenue that facility can actually generate? So if we are at roughly about 200 odd crores right now, can that go up to about 250 or 220, or what is it that we can actually generate from the existing capacity?
We have been talking about this investment, that this would generate about 2.25 to 2.5 times the investment what we have done in this business. So right. we are on as per that particular path.
Okay, if you could just remind me, our investment was about 100 crores?
Yes.
Okay, all right. And on the numbers, if you could just...
ma'am, good morning. I'll pick up your questions on the number side. Firstly, to answer your question on other income, during the year, the total other income stands around 90-odd crores. Of this, if you look at the sustainable other income on a going basis, will be around 40-odd crores, which essentially consists of transactional treasury income of about 26 crores, property income, which is essentially leave license rental income of about 12 crores, and miscellaneous other income of about 3 crores. So this 40 thereabouts, we are fairly confident that will be going on a sustainable basis.
Right.
The balance 50-odd crore, around 49 to 50-odd crores, essentially it has got two predominant components. The net mark-to-market revaluation impact as on the closing date and the revaluations on the transactions for our investment, that stands around 33 crores.
Right.
And there have been certain one-off receipts during the year, including the income tax refund interest receipt of 10-odd crores and some other interest income. So if you stack them all up, it will be about 15 to 16 crores. So this 16-odd crores of one-off interest income and 33 crores of mark-to-market, which at any given fiscal you cannot forecast. So these probably can be called the other bucket, which brings in the total other income to 90-odd crores.
Right, okay. And what is the cash on books as on 31st?
Your next question, the total investment, if I look at between current and non-current on a standalone basis, is close to about 400 crores, is 395 crores, of which the cash and near cash equivalent is around 355 crores.
Okay, so the investment in the group company shares would be right now about 45 crores.
All of the other investments basically are, including property and other group company shares, they were actually at mark-to-market, so that brings in the balance.
Right. Okay, great. Thank you very much.
Thank you.
Thanks.
Thank you. The next question is from the line of Abhijit Akela from IIFL. Please go ahead.
Yeah, good morning, gentlemen. Thanks a lot for taking my questions.
Good morning, Abhijit.
Yeah, first of all, wish you a very happy next innings in your new role, sir.
Thank you very much.
Just on the queries, one was about Manchester Organics. So it seems like there's been a decline in EBIT from from whatever I could gather from the console numbers. EBITDA seems to have gone down from about 8 crores to about 4 crores in FY18. So just wanted to get your commentary on how that business has shaped up this year and what's the outlook going forward.
Yeah, so what you're saying is correct. This year has been a little tough year for us in Manchester Organics. Though profitable, the EBITDA and EBITDA margins have drastically have come down during this year. There are a couple of reasons. One is, of course, the change of the top management over there. The original promoters going out, the senior management coming in. That is one part of the major structuring which happened there. Second thing is, of course, we also had a certain, I would say, ERP investments done into that particular facility. That also had some impact in terms of day-to-day operations of the business. If you ask me as a business model or as a core business, there are no issues over there at all. So it is only, we'll be coming back to normal in next couple of quarters. I don't see any reason in that, because the team is now settled, the automation is done, the coordination between the Manchester Organics, the CRAMS activities in Manchester and in Dewas are well coordinated. So there are some other projects which we are transferring to Dewas based on, or Manchester based on the availability of the capacities. So all those things are going on well. So it is a matter of time that we come back onto the normal business numbers in that place. So basically what I'm trying to say is that there are no significant core issues in terms of the business or the business model at Manchester.
Okay, thank you. That's helpful. And second, on the Piramal JV, I know we recorded 56 crores of revenue until November, April to November.
Yeah.
What was the number for 4Q, if you can help us with that, the revenue number, which obviously we did not record? And also the loss from associates on the consol P&L stands at 2.7 crores. So is it fair to interpret that this is Navin Fluorine's share of the loss for the 4 months after it was divested from the standalone entity?
Yeah, I mean, your first question, the operations have been transferred with effect from 1st of December 2017. So yes, the top line for the JV for the 4 months concluding up to 31st March 2018 have been approximately around 25 crores. And the second part, your study is absolutely right. The 2.7 crores which you see is predominantly coming from the share of operating loss, the Navin Fluorine share of operating loss coming out from the JV for this 4 months, which is about 2.6 crores.
Okay, so just to clarify, 25 crore sales is for 4 months or for 4Q, sir?
4 months.
It's essentially 4 months, which is the fourth quarter plus the last month of the third quarter.
Okay, so the full year sales for the entire operation would have been about 56 plus 25, which is 81 crores.
Roughly thereabouts, yes.
Oh, got it. Fine, that's it. I'll get back in queue for any more questions. Thank you so much.
Thanks.
Thank you. The next question is from the line of Karthikeyan from Suyash Advisors. Please go ahead.
Yeah, good morning, gentlemen.
Good morning.
Good morning, Karthik.
Yes, so just continuing on the earlier question, I'm just trying to normalize the performance for the year and the quarter. So if I take the 2.7 crore reported loss, would it be reasonable to say that this operation would have incurred a loss of around 20 crores for the full year?
No, not really, for a couple of reasons. As we all know that when this transfer takes place, basically the way of working goes through some considerable degree of change, moving from NFIL way of operations into the JV way of operation. So that takes us time to stabilize. We had a bit of top line shifting from the back end of the last quarter, the March quarter, into the beginning of this fiscal. And also we had some stabilization activities going on the ground for which there are some one-off overheads as in spend. So I would say it will not be right on anyone's part to actually look at this 2.6 or 2.7 crores of loss and try and extrapolate this on an annualized basis. These are more effects of the initial streamlining or stabilization of the operations post the transfer.
But just to understand, what would have been the 12-month performance at that level, if you can share that number with me?
As we consistently say that for this particular operation, we expect post-stabilization of operations on a run rate basis, a top line of asset turn of about 1 on the investment, on the productive plant and machinery investment of 140 crores. So basically anything between 125 to 135 to 40 crores would be on a run rate basis a good number to estimate.
Yeah. Okay, fine. Anyway, thanks very much for the clarification, and Mr. Sitendu, best wishes for your next assignment.
Thank you very much, Karthik.
Thank you. Before we take the next question, a reminder to our participants that you may press star and 1 to join the question queue. The next question is from the line of Pawan Kumar from Unifi Capital. Please go ahead.
Regarding this Piramal JV, what are the kind of margins we would be expecting at full capacity? And number two, are we expected to reach the full capacity utilization this year?
Unfortunately, we do not get into discussions, BU-specific discussions of margins. Suffice to say that this model of operation is structured on a standard contract manufacturing model of operation, and the margins expected over here are reflective of the portfolio margin which is normally extracted in contract manufacturing sector. Your second question is basically, do we expect on a full year basis, that expected asset turn? Hopefully in FY18-19, we should be hitting the expected asset turn over 1 on, 140. So, as I answered a while ago, hopefully the turnover top line should be hovering between 135 to 140 crores.
And will this particular investment be margin accretive as compared to whatever our whole Navin standalone margins are?
We would say that with respect to the nature of operations and the landscape expectations of a contract manufacturing model, the margin extraction from there will be representative of the market.
Okay. And secondly, it's more of an accounting question. If I look at your property, plant and equipment, 414 crores has gone down to 281 crores. That is, I guess, the transfer of thermal JV. So where is that particular transfer of 150 crores of assets taken place? Has it been in the financial assets investments column?
You're absolutely right. The movement in fixed assets is predominantly because of the BTA, where the plant and machinery has been moved out from Navin books to the JV books, which is why the fixed assets block has come down considerably. And the adjustment is happening, if it was the last fiscal, basically, there are already advance received from the JV quite significantly. That has been adjusted to that effect.
So that is reflective in the financial assets?
It is reflected in the financial assets.
Long term. That is non-current assets. Non-current assets, right?
The advance received from the joint venture already has been knocked off against this asset transfer. So the liabilities have already been adjusted accordingly.
Okay. And lastly, I wanted to ask you about, we have around 300 crores of cash on books now. So we are generating more than 200 crores of cash per year. So do we have those kind of scale of investments to actually invest this kind of cash, whatever we are generating?
Are you asking, do we have the capacity to invest? Or are we investing?
The opportunities out there.
Yeah, so I'll answer this. Basically, we are looking at various opportunities in businesses, either in specialties or in CRAMS, to invest. So basically, we are, as a management team, we are continuously looking out for opportunities. So as and when the opportunities come, definitely we would like to invest this particular cash which is available to us. The 150 crore investment which are doing at Devas, it will also come mostly through internal accruals and partially only through debt.
Shekhar, is there a chance that we do some kind of inorganic, we look at an inorganic opportunity going forward?
Yeah, we are looking at such kind of opportunities, but as and when something comes up which is, which is compatible in terms of a business model, then definitely we would look at it.
We are open.
Absolutely.
Okay. Fine, I'll get back to you.
Thank you. The next question is from Amarnath R. from Gomukhi Capital.
Yeah. Good morning, everybody. I have a question again relating to the CCPL joint venture. Would we continue to have a supplier relationship in terms of some of our products being supplied to the JV going forward?
We will.
So is that what reflects the revenue from operations of this business at 9.44 crores, which is mentioned in the presentation? Is that our supplies to them, or that's our share of the revenue for the quarter?
I'm sorry, which particular number you're talking about?
This is slide number 10. Key highlights for FY18. And there's a number mentioned, revenue from operations of this business So that's not our supplies to them. That's the share of revenues of ours, the 49% of the revenue of the JV.
Yeah, in fact, just to clarify, because of the Ind AS treatment, the only number which comes in our financials is the equity accounted share of profit or loss. So we do not have line-for-line consolidation for any of the top lines.
Okay. What about the sales we make to the JV or supplies?
One of our products from Inorganic Fluorides business unit we sell to the JV. So that sells to the JV is actually included in the Inorganic Fluorides portfolio, and that is one of their intermediaries.
Okay. Thank you.
Thanks.
Thank you. The next question is from Pritesh Chadha from Lucky Investment. Please go ahead.
Yeah, sir, some clarification on the way the P&L is constructed for the Piramal business. The first 9 months would be a part of your standalone, where you would have done 55 crore of revenue, and there would be a corresponding loss on that business, because when we see the 4-month number, it looks like a 25 crore revenue which you shared and a 5.2 crore loss. So that's about 20% net loss from doing the Piramal business. So would a similar 20% like a 10 crore number would be sitting in your standalone, which when you make the numbers next year for FY19, your standalone should be better by that 10 crore, and whatever you do in FY19 on Piramal gets reflected in the share of profit from the JV line in your consolidated. Is that the fair assessment of this whole Piramal business being bifurcated in two P&Ls, standalone and consolidated?
I'm just trying to remember the first part of your question because it's such a long, winded one. So if your question is basically the net impact of the year, it is not between bifurcation between standalone and consolidated. It's the bifurcation between Navin P&L and CCPL P&L, both standalones. To first answer your assumption whether you should take a 4-month loss of 512 as a 20% and apply that on the 55 crores and therefore get a 10 crore loss, answer is no. As we kept on clarifying that this is the first year of operational stabilization, it is not on a smooth, steady-state affair basis operations. So therefore, any kind of a approximation or any kind of a extrapolation for a full year basis doesn't quite hold in this first year. Yes, in the 55 crores of turnover, which has been captured in the Navin financials, Navin P&L for the 8 months up to 30th November 2017, there have been some part of loss, cannot be extrapolated as a 10 crore loss on a 20% percentile basis. To answer your next question, going forward, hopefully when the JV further stabilizes in FY18-19 and actually clocks the turnover in our expected line of asset turn, since the operations would be stabilized by that time, so it should actually start garnering the returns, the value creation and the margins in the expected lines of the contract manufacturing sector.
Just to recall, what is the investment done in this asset of CRAM and what is the corresponding?
Plant and machinery would be around 140 crores.
And the prospective asset turn on it?
1.
So basically 140 crore type revenue versus which it's operating at, slightly more than 50% utilization currently.
Yeah.
When does the utilization start or achieve the peak utilization?
As I said a while ago, that FY18-19 would be the year when predominant part of the stabilization of the operations will take place. So hopefully by the end of FY18-19, we should see that it's actually heading towards that headroom as a turn of about 1.
Just to add here, Pritesh, basically the team is working on enhancing the capacity to utilization. So basically it is endeavor for all of us to ensure that we increase the utilization as fast as possible, because there is a requirement from the customer, that is Piramals, to have larger quantities moved to them. So it is work which is going on jointly within the companies to improve the utilization as early as possible.
do your team now mind sharing what can be the prospective gross margin or some direction here since you're going to eventually report it? So would it be similar to your standalone operations, CRAMS margin differ?
As Sitandhu had earlier said, it is in line with what typically a CRAMS projects of this kind of things would have. It is a little too early to come on because talk about that.
No. And my last question is on refrigerants business. Whatever research we're doing, there is some spike in prices on the refrigerant side. Just wanted to take your direction on the refrigerants business, both in terms of volume and price-led growth, and how the dynamics in the market are shaping up, especially on the refrigerants.
See, in the refrigerant gas business, we are mainly in R22 gas only. Now, the last financial year has been very, volatility in the price was pretty high. And the prices were actually fluctuating almost about, week to 10 days basis kind of a thing. So we have been closely monitoring the prices, especially in the export market, export coming out of China into the Gulf region, and monitoring our prices accordingly. So we feel that this will continue, and so the price volatility in this particular market will continue to increase going forward, and the same gets reflected in the domestic market as well.
Okay, so what's your volume growth for FY18, the 14% top line growth that we see in refrigerant?
That is mostly coming out of value, that is the pricing, because we have a cap in terms of the capacity. Okay. So it is mostly coming through the pricing.
This price-led growth factor is valid even in subsequent years, you will be constrained by capacity?
Yeah, so we will be constrained by capacity. The pricing is a function of market and the raw materials is the cost.
Okay. Thank you and all the best.
Thanks.
Thank you. Before we take the next question, we'd like to inform participants that in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Amar Maurya from Emkay Global. Please go ahead.
Thanks a lot for the opportunity, sir. So my first question is primarily on the non-the-hedge CRAM side. If you can help us understand, when you talk about a 66% of a yearly growth, in that non-the-hedge, are we also including the R-gas business of 1, 2, 3, 4 YX?
Yes.
Yeah. So, sir, if I knock off that, what would be the growth on a like-to-like basis in a non-the-hedge CRAMS business?
Just a second.
Full year. So 24. It will still be about 45%.
45% growth. So meaning the 1, 2, 3, 4 YX is also picking up.
Yeah, so it's a small piloting facility. It's not a big facility. So that's
a pilot plant. So, it's not major volume.
Okay. And secondly, sir, when we say that, at a peak, when, Piramal JV should be a replica of any other contract manufacturing piece. So, if I see your peers are doing a sweat asset ratio of more than 1 time. So, why we are saying that, at max, this can reach to a 1 times kind of a sweat asset ratio, whereas if I see your peers in a pharma are doing a much better fixed asset turnover ratio.
See, if you see at our Devas contract manufacturing site, our asset turn is pretty higher.
Correct.
Yes, yeah. But that is because it also depends upon the nature of the product, what you are making.
Correct.
Number 1. Number 2 is this investment also included some investment which goes into the I would say OSBL, that is the investment which is required when the manufacturing plant comes up, the site related activities and other things.
Mm-hmm.
Suppose tomorrow we decide to expand these activities, this plant.
Mm-hmm.
Then to that time there is a possibility that the asset turn will be higher because a lot of other utilities and other things would already be there. Okay. So this is absolutely a green venture. So the initial costs are pretty high. And again, the nature of the product. Some of the specialty business, if you see, the asset turns are 1.2, not more than that.
But then is it fair to assume that given that it is a one-time sweat asset ratio business, so you would be enjoying about normal average margin in this kind of a business?
I cannot comment specifically on this, but if you want to really get the margins in this kind of in comparison to the CRAMS business activities, then yes, you need to have initially higher margins in this business. Mathematically, what you're saying is correct. So, but as I said, the asset turns is coming basically because of higher asset turns lower coming basically because of initial investments into the business.
Got that, sir. Got that. And sir, one last.
I'm sorry to interrupt, but maybe request you to turn to the question queue for
sure.
Several participants waiting. Thank you.
Yeah.
The next question is from the line of Srinath Sridhar from ICICI Securities. Please go ahead.
Good morning, sir.
Good morning.
Wanted to know, in your specialty business, what would be the segment bifurcation for pharma and agrochemical?
We have three basic industries where we supply. One is pharma, agro, and chemicals. So typically, chemical business will be about 20%, pharma will be about 40%, and agro will be about 40%.
Okay, agro is about 40%.
Yeah.
And sir, in domestic, who do you supply to which agrochemical companies?
Domestic, we do not have any agrochemical company because they're all technical trial majors, right?
Most of the technical companies are global companies. And there are a couple of mid-size technical manufacturers in India to whom we supply.
Okay. And globally, the companies that you will be supplying to in agrochemicals?
Yeah, these are the big names in the industry.
Okay, like Dow and BASF and all.
Yep.
Yeah, okay. And overall, in the next year, how much volume growth can we expect in all your businesses put together?
It's very difficult to put because we have some products which are commodity products, some products are very highly specialized, so it is very difficult to put one volume number. The number can come in terms of absolute tonnage to tonnage, but that has no relevance because we sell hydrofluoric acid, thousands of tons, then we sell some specialty products which are only, few hundred tons in a year. So individually, each business-wise, we expect the volume growth coming in all our four businesses to next year.
But in refrigerants, you said it's capped. Right?
Refrigeration the volume is capped, so to that extent, yes. But only thing is there we pay a differentiation between domestic and exports, That's the way we do it.
Okay, sir. Thanks.
Yeah. Thanks.
Thank you. Next question is from Gargi Bhattacharya from Shreyas Mutual Fund. Please go ahead.
Good morning, sir. Thanks for taking my question. I have two questions. The first one is related to your gross margin. It has improved significantly in the fourth quarter. So the reason behind it and what do you think the margin scenario in future would be like? And the second question is related to other expenses. It has gone up. So the reason behind it. Thanks.
Gross margin, as we all along clarify in such conference calls, that for an enterprise like us, it'll have numerous factors contributing to the movement in gross margin, ranging from the BU mix, the product portfolio mix within the BU, the domestic versus exports turnover portfolio mix within the BU, and so on and so forth. So it will be very difficult to pinpoint a particular type or a specific set of factors attributing to any significant movement in gross margin. What we always endeavor to do as a company is to sustain this gross margin performance at both a BU level as well as at the enterprise level. Secondly, coming to your question on other expenses, if an analysis of all the key overheads as a percentage of turnover for the enterprise, we think that basically we are not way off the mark. We are all the key overheads as a percentage of the turnover are well within manageable lines and within the industry standards. We got to keep in mind that this is a growth enterprise, and therefore a certain part of investment has to be there in terms of the resources and the capabilities of the enterprise, which entails certain expenditure.
Okay.
We are within industry standards.
Okay. Thank you so much.
Thank you very much. Next question is from Anubhav Sahu from MC Research. Please go ahead.
Hello.
Hello. Hi.
Hi, sir. So, I wanted to comment on the raw material cost inflation. Basically, why there has been a dip, but sequentially it has moved up. And so, if you can comment on that, if you can also comment on the moving parts for that, is it because of fluorspar prices or something else?
Yeah, so some of the raw materials are showing upward trend, fluorspar being the major one. So that the cost of fluorspar has been increasing last couple of months. So that is one major increase. Otherwise, if you see some other raw materials like bromine, that cost is going up. As far as chloroform and other raw materials are concerned, they are pretty steady at particular level. So major increase and fluorspar increase gets, because it's a basic product from where we make all of the chemistry, so that affects most of the businesses.
And as far as I recollect, we don't source much from China.
No, fluorspar we don't source much from China. We are buying from other sources. Another raw material is sulfur, which are also shown a major increase compared to last year.
And so for the near term or near to medium term, how do you see the price trend?
We are finding fluorspar will continue to be at high levels in next couple of quarters. Same thing is sulfur also. Sulfur, bromine, these are the products. So we expect the pricing levels of raw materials to remain at the current level. And other way around is that we don't expect those pricing levels to go down in next couple of quarters.
Okay, so other than fluorspar, you're saying?
No, fluorspar, everything. Fluorspar, sulfur, which are increased this year. Fluorspar, sulfur, bromine, all those things which are increased big way this year. I don't see anything coming down immediately.
Okay, got it. And so how much we would be sourcing from the domestic? We have a joint venture with Gujarat Fluorochemicals.
Yeah, but that is yet not, the project is not yet financially closed. So that will take some time to start getting from our own JV. That is a couple of years away now.
Okay. And sir, on the refrigerant business, regarding a pilot with the Honeywell, what scope we see for scaling it up, and are we really focused on the second generation refrigerant gas from time to time?
So what we are making with Honeywell right now is a product we are making for them, and so it is supplied to only them at this point in time. So as of now, there is no specific commercial agreement in terms of going to the larger scale in this particular category.
Okay, sir. That's very helpful. Thank you.
Thank you.
Thanks.
Thank you. Next question is from Nav Bhardwaj from Anand Rathi. Please go ahead.
Good morning, gentlemen. Congratulations on the fabulous set of numbers.
Thank you.
Could you give us a breakup of the growth that has happened in terms of price and volume for each of the BUs?
Each BU's price and volumes.
Price and volumes. Like if there's 14%, that's perfectly priced.
We don't segregate BU-wise the numbers in terms of the volume and value. But while talking in terms of, for example, when I spoke about refrigeration gas business, I said most of it coming from...
It's predominantly pricing.
Correct. Inorganic business is coming from both volume as well as the pricing. Specialties, again, mostly coming from the pricing part of it. And CRAMS has nothing to do with specific volumes. CRAMS is all independent projects.
Okay.
So this is the overall picture in terms of the pricing and volumes.
Great. All right. Thank you so much.
Thank you very much. Next question is from Bharat Shah from ASK Investment Managers. Please go ahead.
Hi, Shekharji.
Good morning, Bharat.
Good morning. Just to continue from last time when we had discussed, just one point. I deeply appreciate the prudent and capital efficient way in which each line of the businesses that is sought to be built within Navin. Now, on a more longer term basis, rather than any quarter or any particular year, but what we had discussed that given the size of opportunity, our capability to handle complex chemistry and our preparedness to meet with the needs of each of the lines of the businesses that we operate, roughly about 20% long-term compounded value growth or more is something that can be thought of while maintaining or improving capital efficiency. And that will mean that operating profitability either remains or gets improved. Does that continue to remain a fair assessment?
Yeah, from based on what the factors what you have talked of, and our company's ability to invest in terms of the cash what we have, the numbers what you're talking of are fair to assume, and there is a market which is available to grow in with that particular number levels. So I think any prudent management would have those kind of expectations from their businesses.
Okay. So size of opportunity and our internal preparedness both together do make us reasonably comfortable in looking at that scenario.
Right. Absolutely right.
Thank you very much.
Thanks a lot.
Thank you very much. Due to time constraints, we'll take that as the last question. I would now like to hand the conference back to Mr. Shekhar Kanolkar for closing comments.
Yeah, I would like to thank everyone for joining on the call. I hope we have been able to respond to your queries adequately. For any further information, request you to get in touch with SGA or Investor Relations advisors. Thank you very much.